Hello and welcome back. Let's welcome in the management at Happiest Minds. They are now with us. Let me come to you first, Venkat. What we are picking up from report is that Mr. Ashok Soota, of course, who is the founder of the company, is looking to reorganize the structure of the company in terms of management changes, what's happening. Can you just tell us what's happening in terms of reorganization, if any?
Sure. There are two parts to the article that your sister publication, The Times of India, carried out. It's a detailed story on the entire organization structure changes that Ashok has put in place. One is with respect to his holdings in the company, and the other is with regard to the management at the company. So I'll take that, the first part, which is the holdings of Mr. Soota. He today, along with the LLP, holds about 52-53% in the company, and there's been no change to that. And he has created two trusts. One will be a holding trust, and another one is a philanthropical, charitable kind of a trust, which will focus on medical research. And all of the holdings of Mr. Soota would go into these two trusts over a period of time. What he has done is he has got certain trustees managing the trust, and the voting of the shares that are held by the trust would be always in line with the management of Happiest Minds. So that's what he has broadly covered in the Times of India interview that he gave over the last 2 weeks back. Now, coming to the percentage holding, it's 53 right now, and he has also remarked that at some point in time during subsequent acquisitions, dilutions, he doesn't look for that holding to go down to 35%. So that's kind of a future-looking statement, keeping in mind requirements that may happen in the future. The essence of this whole structuring Mr. Soota has done is to ensure that there is a clear transition of his holdings in a very smooth manner, and how it will ensure support to the management of the company. Coming to the company, he talked about the EB structure, the executive board structure, which constitutes currently today the 3 BU CEOs and myself, the MD and CFO. So we work together as a single unit, and we act as a CEO of the company. So each of us have our functional responsibilities. Like Joseph is the PES president of the PES business unit. Rajiv is the president of the DBS business unit, and Ram, president of the Infrastructure Management and Security Services business unit. They have that responsibility, which I would refer to as a functional responsibility, just like mine. I've got finance on the corporate functions reporting into me. So the 4 of us together, led by a common charter, which is, we call it as the EB objectives. That is the objective of the company, aligned very closely with the vision of the company, is what we work together as one unit. So when we come together as an executive board, we work and function as a CEO. And when we go back and disperse and we are back to our business units, we then lead charge on each of our responsibility or functional areas.
And, people would, wonder what this executive board structure is, because it's quite different, right? We function as the CEO of the company, but if you look at in Germany, it's very common to have a executive board or administrative board which runs the company. And what we've seen is, since we've instituted this change around 4 years back, that has brought the various business units and more alignment between the various business units and functions, better understanding for each one of us in different aspects of the company's functioning, more empathy, and the corporate functions are also better aligned. There's more agility in how they function and react, as all the corporate functions report into one of the 4 EB members.
Okay. Joseph, tell us a bit more about the changes to business units. How different are these units, and what will be the reporting structure like?
So from inception, we've had 3 business units. That's the Product Engineering Services business unit, which looks at more of platforms and products. We have the Digital Business Services, which helps companies with their digital transformation journey. The Infrastructure Management and Security, which helps, in helping the customers with your cloud migration, setting up their cloud infrastructure, managing this infrastructure, and then various types of security services secured the infrastructure and applications. So these are the three business units that we've had. And the plan is to continue having these three business units as the go-to-market and the source of all of the company's revenues. And they are supported by, the centers of excellence. We have the Digital Process Automation Center of Excellence, the IoT Center of Excellence, and the Analytics and Artificial Intelligence Center of Excellence. So this is how we are structured.
Come to you. Of course, you spoke about the changes on organization levels which will happen. But say over the next 2 to 3 years, what are the sort of changes that you expect because of this?
So, to handle the question on growth and profitability, just to take you back a couple of years back, the EB structure was put in place in 2017-18. So that's how old the EB structure is. So we have been now functioning smoothly for the last 2.5 years. Within that period, the EB, acting as a team, and the CEO of the company has turned around the financials, which is clearly visible right now, because 2017 was kind of a bad year, and since then we have turned profitable. And we have done the IPO of the company, which has been a successful IPO. So all of this has been under the leadership of the EB, or the EB structure that you're seeing that's been put in place. And as far as looking at growth prospects, we have taken upon ourselves the target of saying we will continue to grow on an organic basis at about 20% year over year. And that's something of a view that we have put out for the near term, short term, and the medium to longer term. And that's what we'll focus on. And what will add to that growth will be the acquisitions that we are again looking at as a team. While the EB structure has been in place and working, the BU has been delivering on their respective individual objectives. Like I said, the functional objective of each BU has its own growth targets, EBITDA targets, PBT targets, and the 3 BUs plus the corporate roll up into the company financials. So if we have to deliver as a company, as a single unit, the EB has to deliver first under the respective BUs and then as a company as well.
All right. Joseph, the industry has seen, strong demand. Accenture reporting a good set of numbers. They also hiked their guidance. You are present, in the US. You have a high exposure there. So give us a sense of how the deal pipeline across verticals and geographies that you're present is shaping up. And do you think that you are seeing even better traction now versus what you had mentioned during the third quarter numbers?
Yes, I think that's an interesting question. What we are seeing is, probably you've seen it in the industry, as you mentioned, the demand seems to be strong across all of our digital capabilities. I think what's driving this is customers. Before I get there, last when we spoke, I'd mentioned that in some of the industry verticals like EdTech, high tech, and media, in Q3 we're seeing demand and budgets opening up, which portended well for Q4. Once we came back from the holiday season in Q4, and somewhere the second half of January, we suddenly saw a big increase in the number of projects getting green-lighted, in the spends opening up in a few additional industries like manufacturing, logistics, industrial, energy, especially in the renewable space and retail. And I think what's driving this is 3 factors. First of all, we had the political situation calming down, post the inauguration. People felt, some of the doomsday scenarios didn't come through. The COVID vaccine rollout is just gathering pace out here. And, the date by which all the adults will at least have one vaccine has been advanced from end of summer to June to May. And now we're looking even April, so which again is very positive. And more importantly, a lot of these industries have realized that what they were trying to do in terms of transformation over 3 years, 4 years, the whole remote working and having less contact in your interactions, they've led to companies realizing that they need to accelerate their digital journey. And we're seeing this increase in overall spend on digital initiatives. In terms of geos, we are again seeing that cutting across all geos, very encouragingly, we are seeing increase in both deals and closures. And what's gratifying is seeing the traction in Europe and Middle East, two geos that when we last spoke, we had mentioned as geos that we wanted to have special and specific focus on. In terms of services, I think the usual digital services around e-commerce, IoT, AI, security, these are the ones where we are seeing increased traction.
In our recent conversation, you mentioned that company is looking for smaller acquisitions. Any progress on acquisitions, and how would you be looking to fund the same?
So we have a very active deal pipeline as far as acquisitions are concerned. So bankers are showing us multiple companies across geos, technologies, but all of them, like we have held until now in the digital space, 100% digital space, so we don't want to dilute our positioning. Two things that we see are, one is the valuation expectations from the companies from the sell side bankers are quite high. That's something that we're seeing. And the second thing is there is also a kind of rush for hiring or acquiring these companies from the large companies, so which is what I think is driving the valuations today. But so what we are very careful about is, while looking at these names, talking to management, sifting through what's best suited for us, we are looking at companies which we have said are in the range of 20 to 30 or $40 million in size, 100% digital, profitable, and which has a culture which will blend in and which will go nicely with Happiest Minds, because the effort of Happiest Minds has been to put in place a company with a great culture, which is what you see today. So we don't want an acquisition to come and muddy waters on that front. So while we have these, I would say, check boxes, we are very careful not to overpay for a company. We are very clear that we need to buy a profitable digital company. So kind of a lot of these check boxes need to be looked at. So this long deal pipeline that I talk about has to be tested against the touchstone of all these variables that I talked about.
Okay, Mr. Venkatraman, we have seen very sharp margin expansion. The question, of course, is can it be sustained going ahead, as there will be salary hikes from the 1st of April onwards. The economy is moving up, so we could perhaps see, some cost benefits receding. Do you think that there could be any changes to that margin band that you had shared earlier?
Not really. The stable, sustainable margin band that I've been talking about has been 21 to 24%. And like you rightly said, we are looking at pay increases effective April 1st. We have advanced the cycle by a quarter from what we would have normally done. And we also shared a couple of days back with another publication that we are looking at giving double-digit kind of percentage in terms of pay increases. So all of this will start showing up as cost increases for FY22. And we make up largely for that through volume increases. We are talking about a 20% targeted revenue growth on an organic basis. And onto that, you need to bolt on what we have done as this acquisition, which culminated or which is this year. So all of that has to pay for the cost increases. And some of the cost benefits that we saw during the COVID pandemic lockdown, which has contributed to the margin expansion, will obviously start reversing, and which is what takes us back to the 21 to 24% kind of a band sustainable margins. And we are holding on to that as we look into FY20.
Okay, Venkat as well as Joseph, thanks so much for joining us and, just speaking to us about, what the plan is for Happiest Minds going forward from an organizational perspective, as well as, on how things are on the ground. On that note, we'll take a very short break, but when